Small-cap stocks are showing promising signs of outperforming large-cap stocks, and it's time to explore why. Welcome back to Old School Investments. In today's video, we'll delve into why small-cap stocks are becoming an attractive investment option. We'll discuss their recent performance, the impact of declining borrowing rates, and surprisingly high dividend yields. Plus, we'll cover the risks you need to be aware of and recommend some ETFs to consider. Stick around until the end because we have an interesting bonus topic that you won't want to miss. So, let's get started. Over the past decade, large-cap stocks like Apple, Microsoft, and Amazon have dominated the market. They've been the go-to choices for investors, consistently outperforming their smaller counterparts. But recently, there's been a shift. Small-cap stocks, represented by the iShares Russell 2000 ETF, IWM, have gained over 7.5% in the last couple of months, while large-cap stocks have remained relatively flat. This shift is worth paying attention to. One of the main reasons small-cap stocks are becoming more attractive is the decline in borrowing rates. Smaller companies often rely heavily on bank debt to finance their operations. When interest rates fall, these companies benefit disproportionately compared to their larger counterparts who might have other financing options. Lower borrowing costs can lead to better financial performance and, ultimately, higher stock prices. This is crucial because the ability to secure cheaper financing can enable small-cap companies to invest more in growth initiatives, such as research and development, marketing, and expanding their workforce. All these factors contribute to improving their competitive position in the market. Now, let's talk about dividends. Believe it or not, the Russell 2000 is currently yielding a slightly higher dividend than the S&P 500. This is surprising because larger, more established companies usually have a better ability to return cash to shareholders. However, the S&P 500's yield is at a 22-year low, making the higher yield from small caps quite appealing. This higher dividend yield can be particularly attractive for income-focused investors who are looking for steady cash flow. Additionally, the potential for dividend growth in small-cap stocks can be significant as these companies mature and become more profitable. Before you get too excited about small-cap stocks, it's important to consider the risks. Small-cap stocks are more exposed to sectors like industrials and financials, which can be volatile in a weakening economy. These sectors also tend to carry more debt, making them more vulnerable to liquidity issues. While the rewards can be great, the risks are also higher. For instance, small-cap companies might face challenges such as limited access to capital markets, higher borrowing costs, and greater sensitivity to economic downturns. Investors need to be aware of these risks and conduct thorough research before making investment decisions. If you're looking to diversify your portfolio with small-cap stocks, there are a few ETFs to consider. Besides IWM, there's the iShares Core S&P Small Cap ETF, IJR, and Vanguard Small Cap Index Fund ETF, VB. These ETFs offer low management fees and track closely in terms of performance. Diversifying through ETFs can help mitigate some of the risks associated with individual small-cap stocks by providing exposure to a broad range of companies within the small-cap space. This approach can enhance the overall risk-return profile of your investment portfolio. In summary, the landscape for small-cap stocks is changing. With declining interest rates and higher dividend yields, they are becoming an attractive option for investors. Just remember to weigh the risks and consider diversifying through ETFs. The combination of lower borrowing costs, potential for significant growth, and attractive dividend yields makes small-cap stocks a compelling investment opportunity in the current market environment. Before we get to our bonus topic, if you're enjoying this video, please hit the like button and subscribe to our channel. Your support helps us create more content like this. Now, for the bonus topic, did you know that small-cap stocks often have higher growth potential compared to large-cap stocks? This is because smaller companies are generally more agile and can adapt to market changes more quickly. They also have more room to grow, which can lead to significant returns for investors. Additionally, small-cap stocks are often under the radar of large institutional investors, which means they can be less efficiently priced. This inefficiency can create opportunities for savvy investors to find undervalued stocks with strong growth prospects. That's it for today's episode of Old School Investments. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an update. Thanks for watching, and happy investing!